Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, September 20, 2017. We're looking at a daily chart of the SPY, or SPDR, which is the proxy for the S&P 500. So today was Fed Day. It was the FOMC announcement, and then they had a press conference. Janet Yellen held a press conference. So basically, in and around that time frame, the markets go up, they go down, and the markets tried to break down a little bit, but where they were supported should come as no surprise to anybody, 248.91. In fact, the low today, I think, was a penny above that. The low today was 248.92. And so that level, which we know is important, which is why the line is on the chart, is important to the markets, and that's where we found support this afternoon, and that's where the market bounced up from and then finished near the highs of the day. For the time being, that is a bullish sign, and we have probably another day or two of upside in this market. My expectation is that we're going to take a little bit of a run higher over the next day or two. And I don't mean that much higher. I mean, we certainly could go up another, let's say, $1.50 to $2 on the SPDR on the outside. I don't really foresee that happening. However, it could happen. What I'm really expecting is about another $1, maybe not even on the SPDR, up to about $2.51, give or take. Now, here's what we have coming at the end of the week, and this is interesting. Again, I'm not necessarily wavering from the fact that I still think we're going to see a corrective phase take hold of the market between now and the end of October, beginning of November. The original cycle, and I know I've said this, many times, and I apologize for repeating myself, but my original cycle only lasted for a couple of weeks. It was from the 8th of August to the 21st of August, so basically a couple of weeks worth of trading. And then the market really found a low and rallied up from there. Now we're at new highs, making a bullish consolidation pattern in this current range above 248.91. Remember, what was once resistance is now support. So 248.91 was support today, and therefore I do think there's slightly higher prices coming into the end of the week. But what is the end of the week? Interestingly enough, Friday afternoon at 4:02 p.m. Eastern Standard Time happens to be the fall equinox. Why is that important? It may not be important to most, but it's important to me because in that time frame, the fall equinox and 3 other points in time during the year are generally seen as turning points in the market. So there's really 4 important time frames that are equinox or solstices. So we have the March equinox, we have the June solstice, we have the September equinox, which is coming up Friday after the close, so leading into the weekend, and we have the December solstice. These are generally turning points for the market. Doesn't have to be that way, but they generally are. If you go back and look at charts, you'll see that there are plenty of times where the market will either find a high or a low in and around the March time frame. September tends to be a volatile time of the year into October. Not every year, but it happens a lot. And December, we generally see a Christmas rally. And whether or not that's directly attributable to the solstice and the equinox time frames, that's debatable. However, I think it could be an important turning point for the market because if we're trading up into that time frame, I think the odds favor and the probabilities favor that we do see a turning point after that occurs. We'll see how it all plays out over the next couple of days or into next week. But as you know, I'm a very large proponent of time is much more important than price. And I think this is an interesting and important time frame we're coming up into. So with that, let's go over to the IWM. And by the way, at the end of the day, even though the SPDRs finished on the high of the day, they're basically flat for the day. They finished pretty much where they opened. So no change in the SPDR other than the downtick after the Fed announcement. But that's generally speaking nonsense because who knows who's jockeying for position after the Fed announces. With the Fed announcement, a lot of program trading, a lot of computerized trading. So we're not going to make too much out of that. When we go over to the IWM, what we see with the IWM is it is making a run for the high. So the high comes in at 144 and a quarter. So that's basically less than 50 cents away from where we are now. I think we're going to have that number by the end of the week. We may even surpass that number. Maybe it puts in a reversal. Maybe we go through that number and close above that number. I don't know exactly what's going to happen over the next 2 days, but what I do know is we're very close and close enough to where I think that the IWM will at least make an attempt at the old high at 144.25. It's been quite the rally for the IWM. When you look down here on where we were when the spider was at its low point, the IWM was certainly much lower in proportion to where the spider was. But look what happened next. We took off to the upside in an extremely fierce way. And what happens? The IWM, although still lagging the spider from where it is in relation to its all-time high, we are at least leading the markets on the upside of recent with this type of rally. This was a very, very strong rally, and we just have to do nothing other than tip our cap. As you know, the IWM is and remains my favorite leading market indicator on the up and the downside, and right now it is leading the market. While it's not at all-time highs, it is leading the market by the nature in which it's trading. It's up just about every single day, minus a couple of days here and there. It has been in a perpetual bullish stance since it found low around 134 all the way down here. When we look at the transports, nobody should be surprised, because for the last few days we talked about the fact that the transportation average, the DJT or the Dow Jones Transports, was making a bullish pattern in this fashion, and I'll draw it out again just like I drew it out the last couple of days. Okay, so we have an up move and we have a bullish consolidation pattern, and that will generally result in another up move. The market was basically buying time, consolidating or building energy for the next move higher. That's exactly what happened today. Just like the IWM, I wouldn't be surprised to see the transports make an attempt at their all-time high that comes in at 97.63 spot 66. We're not that far away, just over 100 points away, and we were up 147 points today on the transports, finishing near the high. That's a very bullish sign. It could be a sign of exhaustion if it was on volume. However, it was not. Therefore, I do think that they make a run for the old high over the next couple of days. It would be very interesting to see the IWM and the transports reach their previous highs right around the same time as the solstice Friday afternoon. That would be an interesting recipe for a potential reversal leading into next week. If we're going to get one at all, this is the time frame that I would expect it to happen after the the equinox. After the equinox, after Friday afternoon, that would be a perfect recipe for that to all take place. IWM transports at highs, market at new highs. The equinox comes in after the close, and into next week we sell off. That's a possibility. I'm not suggesting it has to happen. I'm not suggesting it will happen. But if we see a market reversal, then we'll know that we may be onto something for some downside activity. What we're going to be looking for into next week or Friday or tomorrow or Monday, Tuesday, Wednesday, whenever, we're looking for signs of a reversal. We're looking for either a high volume reversal day. We're looking for a doji candle on volume. We're looking for the market to give us a tip-off, the market to give us a signal that it's reversing trend. That's at the point in which we can take a trade on the short side if you're so inclined, because we will have something at that point in time to trade against, knowing where we would be wrong. When markets are this strong and we have several markets at new all-time highs, that's at the point in which you have to have an area where you know you're wrong in order to take a trade like that, because markets can always go a lot farther on the upside than people believe, and they can always go a lot farther on the downside than people believe. So we have to be able to identify the spot in which we're wrong, and we're able to move out of a trade. We want to be able to, if we're going to have to, lose small and fast. Just like we discussed last night, here again is the XBD, or the broker-dealer index. We had another nice big up day in the broker-dealer index, up almost 1%, over $2. And with the broker-dealers up, the financial sector up across the board, the market is not going anywhere except higher. When the market is in an upswing, you can bet your bottom dollar that the broker-dealers and the XLF or the financial spiders aren't far behind or, in fact, are leading the way. Now, we're not at all-time highs. It's a very similar chart to the transports. It's a very similar chart to the IWM. But without the financials going down, it's unlikely, and I know I say this all the time, and I don't mean to be repetitive, without the financials going down, don't expect the market to go down. And as long as the market's going up, you can expect the financials to follow suit, or vice versa. If we see a divergence and the financials start to fall, that would be a potential leading indicator, but that's not what we see today. What we see today, very similar charts that we've seen in the transports and the IWM. The question is, are the broker-dealers going to make all-time highs or at least challenge the old highs? They're on the way. We'll see if they can do it over the next few days. Here's a chart of gold futures. Now, nobody should be surprised at where we came today in gold futures. What we talked about the last couple of days is, even into last week, I said if the gold futures chart, if gold traded below or closed below the 20-period moving average, then the likely scenario would be that we were going to come down and test or check in at the former breakout area. That's right here. Okay, we had a consolidation point, right? We consolidated for a while, and then we broke out. We made a top, and markets like to come back and check in at former breakout areas. It's also known as the scene of the crime. So what happened today was we came down to check in at the former breakout area. The low today was 1299.50. What I had said over the last couple of days was maybe it's 1295 all the way down to 1292, who knows? Maybe it's 1297. The low of this candle, I believe, was 1297. Yeah, the low of this candle is 1297. So we came up just short of the low of the big green up candle, which was the breakout candle. But we came to what? A big, fat, round number 1300. We pierced it by a little bit, making a low of 1299.50. So we pierced it by 50 cents, and that was it. And then they took back off, not necessarily to the upside, but bounced slightly off that level. The reason I'm spending time with this is because this is not a discussion that's limited to gold. This is a discussion that happens on all charts, all time frames, all the time. It makes no difference what we're talking about, whether we're talking about a chart of Amazon, Google, Intel, Apple, gold, the spiders. It doesn't make any difference. All charts act and react the same way. And that's why I'm spending some time on it, because we talked about it in advance. We should expect markets to come back and check in at former breakout and former breakdown areas. That's exactly what happened in gold. So this one played out exactly as we mapped it out over the last several days. Silver already came in to check in at the former breakout area a couple of days ago. Yesterday we had a sideways day, and then today we did come down farther, touched the 50-period moving average, and bounced off that number. We generally see gold and silver trade in tandem. They don't necessarily have to trade side by side all day, every day, but in large part, they trade pretty much in tandem. The charts don't look that dissimilar. They look, in fact, very similar to each other. The funny part about gold and silver is that if you went and looked at the news, go read, some stuff on CNBC.com or watch CNBC, and if you catch anybody talking about gold and or silver, what they'll tell you is the reason why gold was down today had something to do with the Fed. And that may or may not be true. But the funny part about it is we talked about gold coming down to check in at the former breakout area a couple of days ago. That's where it was headed, regardless of whether the Fed was having a meeting or not. And it just so happens that today was the day that was the perfect excuse, because the Fed did have a meeting. It was a great excuse for gold and silver to be on the move, but gold in particular. It was a great excuse for it to be on the move. It did what we said it was going to do, but it just happened to do it on the day the FOMC met. You couldn't write the script any better than that. Looking over at crude oil, crude had been making a bullish pattern over the last few days. It tried to break out today, didn't quite get up too far. We did make a new high, but it was rejected at that high. But we are beginning to break upward. And as you can see, the 200-period moving average is hovering over price. we're consolidating underneath the 200 period moving average. And therefore, we can certainly go through the 200 period moving average on an upswing. The question is how far, and I just don't think that we can get much beyond $52 a barrel. Maybe we get up to this high here at 53 and change. I don't even see it getting that far. It is possible, just not probable. 53 is way up here. I don't see that happening anytime soon. But 52, I think, is in the cards. I do think we're going to find a pretty fair amount of resistance at $52 a barrel. Nothing's changed from the crude oil perspective. Everything remains exactly as we've been discussing it. No surprise with the price of bonds today. Yields were up once again. Obviously, you can use the Fed as the excuse if you'd like. Yesterday, we talked about the fact that it pretty much had to come down and touch or pierce through the 50-period moving average today. That's exactly what happened. Today was the perfect recipe for that to happen with the Fed talking. And we talked about it yesterday. When the Fed has an announcement or the FOMC has an announcement, all the markets are going to move. They don't necessarily have to move a lot, but they're all going to move to some extent. That's just the way it works. And so today was a perfect excuse for the bond market to come down, pierce through the 50-period moving average, and we pretty much closed, for the most part, right around the 50 moving average. Tomorrow marks the 10th day from the recent pivot top in bonds. I think this is a good excuse for bonds to find some kind of a low, whether it's tomorrow or Friday, and I think that it's oversold, at least in the short term, and therefore my expectation is that we would see some kind of a rally ensue in bonds, whether it's this week or into early next week. That's what I see setting up in the near term. Last but not least, we'll cover the dollar, and the dollar caught a nice rally today off the Fed, whatever they said. I don't even know what they said, by the way. I know they didn't raise interest rates, and I don't really know exactly what else they said. I don't watch it. I don't care. I just look at price. I have no idea what they talked about, but whatever they talked about seemed to be positive for the dollar. Whether that's temporary or not remains to be seen. The dollar did close above the 20-period moving average. At least from a short-term perspective, that's positive. I don't necessarily think that the dollar's going to get on much farther from here or get up or higher much more than this. I think we still are in a downtrend, and I'm looking for 88 cents on the dollar. If I'm wrong, but that's what my work is telling me, at least for the short term. This could be a one-day wonder for the dollar. Again, all markets move in and around the Fed, so you have to discount some of the movement in the dollar today from the fact that the Fed said whatever they said, and whether it's short covering or panic buying, however you want to term it, there was buying in the dollar. But if most of that was attributable to the Fed, we could start to see it subside as early as tomorrow. So we need a couple of more days to let that dust settle a little bit, especially in the currencies. And with that, I'm going to wrap it there tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.